Hey trader, Steven here. It's Thursday, headed into the close. Back from vacation. I did not shoot a webinar last week, so we have a lot to talk about today. You'll have to excuse me a little bit. I do have a cough, so you might hear me cough a little bit, but lots to cover today. Some markets are incredibly bullish, some markets not so much, so we're going to get in straight into that. I really want to start with the NASDAQ here. It was really interesting because the NASDAQ really sold off right here, found support at the 50-day moving average, and you can see down here it really had a cluster of distribution days. Well, it hit right on this trend line, which is also the 50-day moving average, came down, kind of filled this gap right here, and then just found support and then continued to trend higher. Lots of accumulation coming in on the tech side, which is really interesting, especially, you know, after you have kind of distribution over here, then not a lot of accumulation on the, the upward thrust. And then you have more distribution, and just when you think everything's going to crack, it finds support and got some accumulation. So I think we're getting close to just another potential pullback. Doesn't mean we're going to have a correction, but it's really just kind of a simple mindset. Every time the NASDAQ seems to kind of just grind its way in a zigzag higher, it makes a new high and then pulls back, and then it makes a new high. So it's really close to making a new high. So we'll just kind of see if it comes back and finds support, or maybe takes a little deeper of a pullback. But this 76.25 area I think is really important. If it doesn't find support at the 50-day moving average, I wouldn't be surprised if Friday we just get a thrust, just break into an all-time high, and then we start to pull back on Monday. But we'll have to wait and see. If we look at the S&P 500, is actually on a relative basis doing better, but it's kind of interesting to me because every time it's in this rising channel, and every time the S&P has hit the top of this trend line, which it did on, say, Thursday, so that would have been Tuesday, it tends to pull back, and you can see it did right here and then pulled back, but it didn't really go that far, and then it hit it again. So it could kind of make one more upward thrust, but I'm just going to kind of wait and see. But I wouldn't be surprised. I would let the market come to you a little bit, because I think we are maybe just a couple days away from the market pulling back a little bit, just based on this pattern right here in the S&P 500, and the fact that the NASDAQ is probably a day from hitting an all-time high, which is typically where it likes to pull back a little bit. So, sometime next week, the market's getting a little frothy. So I can't help but to think this is a very important trend line, and so far the last 5 times this has played out. So maybe even it breaks above the trend line a little bit, but I think if it does, and you get kind of another 1 or 2 day pop, if you have some short-term positions that you're swing trading, that might not be a bad place to consider taking a little bit of profits off the table if you don't want to let it come back to the middle or the bottom of this zone. And you can see kind of every time it's done that, it's dipped below the RSI 5 in the 30 on the oversold. It would have been a pretty good here. Let me kind of inspect that. Coming out, not exact, it's not an exact science, but you can see that it'd be a pretty good opportunity, a pretty good buying opportunity. So we'll just kind of have to wait and see. The market's been overbought a little bit. It's really, really strong right now. But there's some interesting things kind of happening under the surface, and I just want to show that to you. You have to be a bull right now. I'm kind of thinking there's going to be just a small, pullback couple weeks, plus we're heading into August. But there is a chart that I sent my subscribers that I do want to show you real quick. Had to take a drink of water. So you have the S&P 500, which is almost at an all-time high, okay? And it hasn't hit this level since the sell-off at the end of January, where the NASDAQ has cleared it 2 or 3 times. So the S&P 500 is definitely lagged, but you really have just this monster trading range right here. But what is interesting to me, now breadth is still strong, price is still strong, but really in the last month you have some of the more aggressive indices have been underperforming the S&P 500. So this is the small caps, excuse me, relative to the large cap S&P 500, and it's lagged the S&P 500 really since, we'll go down here, probably the very end of June, very beginning of July. So it has not. So large caps have been leading the more aggressive small caps, which has been interesting because the dollar has been strong, and typically that means that the small caps are going to outperform. And then you have the NASDAQ, which has been lagging the S&P 500 around about the same time, kind of peaked right here. Now it's lagging, but for the most part, it's not lagging in a big way. I don't even know if I'd call this a negative divergence. It's because it's kind of just going in line with it a little bit, kind of zigging, zagging a little bit. But it has been underperforming, peaked around the same time the S&P, or the small caps, are underperforming. And then you got the IBD 50, which is the kind of stocks I like to trade, growth stocks, momentum stocks, kind of the strongest technical and fundamental stocks in the market. This is the FFTY ETF. It peaked relative to the S&P 500 right around the same time too. And this really makes a lot of sense because I've noticed a lot of the momentum stocks, kind of a lot of the faster moving stocks, they haven't really had any momentum behind them unless it has to do with earnings report. So I've been combing the volume scans, on a daily basis, and everything that's popping is popping on an earnings day, and then it might pop for 2-3 days, but kind of as a collective whole, they don't really seem to just, really be moving, at least from a volume standpoint, and that makes sense because it's definitely lagging the S&P 500. And, in a really strong market, the kind of market that's a little bit easier to swing trade, you definitely want something like this to be outperforming the S&P 500. So again, the S&P 500 can lead. There's nothing wrong with that. Sometimes it just means a sector rotation. But it kind of seems to me that, it definitely seems to me, just looking at this chart, that the stocks that are moving higher or that are leading aren't the more aggressive ones. And we're going to look at some other things, some utilities, but I still think you have to be bullish. And when you start to see stuff like this, wait till the price action breaks before you go screaming the sky is falling. So this price action is still bullish. NASDAQ is about to break out to an all-time high. Follow that first. Just be aware of these things that are kind of happening, because sometimes it can happen months and months before any major correction. I'm not even going to say bear market right now, just because, I don't know, I don't like being bearish until it's time to be bearish, so try to be a bull as long as I can. But I just think this is really interesting, and I looked at this relative chart of the FFTY just because I just noticed just the momentum stocks, they just weren't moving. They pop one day and then they come back. And that's the kind of stocks that I like to trade. So let's look at the dollar a little bit. So this is the USD weekly chart. It broke out clear as day. This is, trend reversal. Broke out of an inverse head and shoulders, and I'm not one for price targets, just because I don't know, I personally don't like to put a target on something. I more just try to follow the trend and not try to say, oh, this should hit this price XYZ, because then you kind of messes with your psyche a little bit. But if you do, a lot of times some professionals they'll take the depth of the head and they'll put that on the upside. And if that's the case, we're looking at about a 6-point upside from, let's just say 95s. I mean, they could put you around 100, anywhere from 99 to 100, all the way up here. That the dollar could move upward if you do that. But now that's not going to happen overnight. It's just not going to I don't think, thrust straight up here, because this inverse head and shoulders, this took a year to form. This goes all the way back to July of last year, July 2017. But to me, I don't think there's any question. The dollar is strong, and that's pushing down emerging markets, international stocks, commodities. It's just everything's going the other way. So, I mean, I hope by the end, if you learn anything, and I've been talking about this for a couple months now, you definitely want to overweight U.S. and underweight international, because the dollar is just going to push everything down, and it has been. But this breakout, this is a decisive breakout. There's no question. It's not like peeking through the line. So, and they don't go through straight up. They zig and they zag, and they might base on top of this. But for the most part, the dollar, in my opinion, is now in a bull market. So we'll just kind of keep that in mind. And you can see the S&P 500 relative to emerging markets, international stocks, is smoking them. Like, it's no question. We have death crosses in international stocks and emerging markets, and we have an all-time high in the S&P 500. So let's look at the commodities, because the other side of that coin is commodities. So let's look at the CRB. Right down here, you have a inverse head and shoulder. You had a breakout, and I just think it's going to fail. You're about to have a death cross in the CRB, which is never good. I think at best you fall back into a trading range, but just based on what I'm seeing, it just appears to be that commodities are going to go the other way, which takes away from the inflationary argument side of things. But, if you got a death cross in the CRB, and if I draw a trend line right across here, that's broken. I'm going to kind of color that blue. Let me just, nope, let me save that. So you have a failed breakout. You have a failed breakout. You have, it broke the 40 week. It's about to have a death cross. It broke the trend line. It's crystal clear to me that at least the commodity index is not in good technical shape. So I would just be careful. Because commodities can go down for a long time, and they can go up for a long time. So just kind of keep that in mind. At the end of the day, when I try to just look at long-term trends, sometimes I just think the golden cross, death cross rule is the simplest way to go. Is the 10-week moving average above the 40-week? If yes, you're in a bull market. Is the 10-week under the 40-week? If yes, you're in a bear market, and we're about to get that cross right here. So just be very mindful of that. So when with the CRB, it usually takes a lot of the emerging markets down with it. This emerging market trend line broke a couple months ago, going all the way back to 2016. This was a roaring bull market, doubled clearly, but you're in a death cross now. So makes a lot of sense with the dollar being strong. China is just not getting a lot of love. It's at the Shanghai Exchange is at a really important place at this 2650 level. It's about 100 points above it right now, but you can see right here that if it broke back early last year, it broke a trend line going back all the way to 2014. Then you could say, okay, I want to draw another one. Earlier this year, that trend line broke, and now it is very close, a few percent away from, maybe about 4% away from just undercutting this. And I mean, if that happens, I don't really know what to say. I just don't know if I'd be owning Chinese stocks anyways, but it is clear to me that they are getting beat with a stick. They weren't doing good anyways. This is not a bullish pattern right here, in my opinion. This is just kind of a long-term rising wedge. But I mean, as far as the trade war go, they're getting the short end, and it is obviously hurting their stock market. Now, let's look at the other side of that. If the two presidents come to an agreement, tensions come down, let's just say they, lower their trade barriers, I think that could be a major opportunity for some of the Chinese ETFs and Chinese stocks. But, right now it's in a bear market, it's in a downtrend, so I'm not seeing really any signs of life to point otherwise. What's next? Okay, so I want to look at bonds for a minute because it's kind of interesting to me. So you have the TLT, the 20-year bond ETF, okay? It has been in a bear market since all the way back to the middle of about 2 years, okay? So this is a 2-year downtrend. You had a counter trend rally, just didn't do anything. So you had a double bottom right here, and then it got rejected at this trend line. So it's touched this trend line twice. I thought, I was looking at this about a week ago, I thought that it was going to, it's at a really interesting inflection point, which is relative to the interest rates, obviously. I thought this was going to crack. All of a sudden, it's starting to reverse at a very interesting juncture. So if this continues to head higher, that's going to be negative for interest rates. So it basically means, you know, if this rises, they have an inverse relationship with interest rates are going to fall. It's going to be bullish for utilities, REITs, bearish for financials. We're at a very, very interesting level, and it's interesting because if we go to the 30-year bond, if I were a betting man, I would say this is going to break out. But we're really close. And let me go to the look at the yields real quick. The 10-year yield. So, and this is a very, very long-term chart, but it's falling a little bit this week. I don't want to say that it's stalling because this is just such a long-term chart, but this could easily pull back a little bit in base before it comes back and breaks out again. And I think that since it's at an interesting juncture, and it looks like bonds are trying to reverse and break out, which would put downward pressure on this, I'm really, really keeping an eye on it, but that could provide an opportunities in utilities and REITs, which to me are looking bullish after they've been very ugly for a very, very long time. So let me look at that real quick. So you can see that down here that if the treasury yields, whichever way they go, they are negatively correlated with utilities. So if the bonds go up, yields go down, utilities go up, and vice versa for the financials. The financials are positively correlated with the yields, negatively correlated with the bonds. So if the bonds go up, typically financials, and this, I represent the financial with the XLF ETF. That's probably not so good for the banks and things like that, at least not yet. I'm not saying this is going to come all the way back down here, but I am seeing more evidence in REITs, utilities, and bonds that are having bullish setups that suggest that, and that suggests to me that interest rates could ease a little bit. So let's go look at XLU. So, I mean, if we just look at utilities here for a second, been in a downtrend. It has been one of the worst performers, and all of a sudden it just surges up, creates a bear flag, breaks out, comes back. It's right in this test breakout zone. Is up today as yields are falling today. To me, this looks bullish. It's in an uptrend. You have the golden cross. You have breakout. So far, it's holding. Now, everything could change in a day, but this looks bullish. Bonds are looking like they're curling up. And if we look at the, let's just look at a REIT ETF. This is the Vanguard REIT ETF. I mean, that looks bullish too. I mean, that is pretty much right at an all-time high. Looks a little stronger than utilities and has been pretty much gone straight up in the last several months. Has definitely outperformed the overall market in the last several months, or at least it looks like it has. As far as the steepness of this climb, and now it's right here at this level and pulling back. So, you know, is this a cup with handle? Is it going to break out, or is it going to pull down and base a little bit? I don't know, but this looks bullish. Utilities looks bullish. Bonds look bullish too. We'll take it week by week, but it looks to me, like interest rates could pull back a little bit. So we'll keep our eye on that. Now, kind of moving back over to the commodity side of things, I want to look at gold, and gold does not look good. Just the price of the bullion. Let's go look at it. you have gold that has, and this is just the gold contracts. I really thought that right when it was around here, I thought that it was looking like it was trying to break out, which would have been incredibly significant because it has not gone anywhere since the end of it. Really, this has kind of been basing for the last 6 years. It just broke a 3-year plus trend line. That is, let's say it falls back into a trading range at best, but I mean, it makes sense. The dollar's breaking out, the bullion's breaking down, but to me, that gold does not look good. It is breaking the trend lines, it's breaking support. A lot of with other materials such as oil, and oil looks like it's very vulnerable to the downside, so let's look at that. But I take this break pretty seriously. That's a decisive break. So at the moment, I do not want to be long. I do not want to be long gold or commodities. Oil is interesting because it popped on Tuesday, and it was at the beginning of the day. It was a really bullish pop. And it was right at this downtrend. It was looking like it was going to break out, and then it's just pulled back a little bit. So I'm really watching up here, West Texas. It's just, I heard something interesting from a guy that I follow, commodities, and he just made an interesting point that if gold and materials and all these other commodities are starting to break down, oil's hanging in there, but does oil eventually crack? It is on a trend line, and actually what I want to do is I want to take this trend line and even see if I can thin this out just a little bit. It is on a trend line that goes all the way back to February, so it's not a long trend line, but I would not say that is a decisive break of the trend line, but if it gives way next week, I mean, that would be a decisive break for oil, and that would kind of be, in my opinion, the last commodity to look like it's just going to crack wide open. So I'm really keeping my eye on this right here because it is sitting on the trend line, but I would also be cautious because with West Texas on that 6-month trend line, it looks incredibly vulnerable. Now, the thing that kind of intrigues me about this, which is why I'm not going to call it just yet, on the flip side, this is the XES, the Oil and Gas Equipment ETF, relative to West Texas Intermediate. On the bearish case, you have a relative breakout relative to the price of oil. So that means oil stocks have really been outperforming oil since July. You can kind of see this upward trend. Now it's trying to break through. It's not necessarily a decisive break, but it's starting to break out relative to the price of oil. So we're so close to having this figure itself out, and I would just, if this breaks, I'm not going to really I'm not going to say, okay, we still need to be in oil stocks just because oil is outperforming, oil stocks are outperforming the price of oil. Typically, it's going to follow the commodity, and if this breaks, I'll move to the sidelines or at least stay away. But it's kind of the last one that's hanging in there, so it's really important on the CRB side to wait and see and watch what happens with this. Let's go look at where is that? Okay, let's look at the sector ETFs. Okay. Excuse me, I have to keep taking a drink of water. So you have the consumer discretionary. Let's just start at top. No specific order. Bullish. Okay, so finding support, the 50-day moving average, discretionary stocks, retail stocks. I mean, everything about that is looking right. And you can see kind of the last time it hit an all-time high, it did pull back. It's kind of got that zigzag look like the S&P 500 and the NASDAQ. So that's a bullish sector making an all-time high. It's hard to be bearish. So you have technology, the XLK, that has not hit an all-time high. It looks just like the NASDAQ, just a few points shy. but continues to find support. It's in an uptrend. If I could draw a trend line right here, it would still be above it, so we'll continue to keep our eye on that. Industrials, I could draw a trend line right across here, and it would have broke out and found support on this day right here. But it's just kind of holding, and that's still bullish right there, but not the strongest, excuse me, not the strongest one. Materials definitely look a little weak. They haven't really gone anywhere. They're just trading sideways, which makes sense. You know, you have a lot of the commodities in here, so, you know, up a little bit today, but, you know, there is no real trend on the XLB. XLE down today, looks vulnerable to the downside, right on a trend line if I were to draw it across here, so we'll just kind of have to keep our eye on energy. Looks vulnerable to come all the way down here, but we'll just kind of have to wait and see. XLP, the consumer staples, your cereals, your cigarettes, your alcohol, you know, Heinz, ketchup, you know, recession-proof type stocks, made a really bullish move and is now pulling back. It is on a really nice uptrend. Maybe it needs to pull back a little bit more, but still in a death cross mode, but I have a feeling that's going to change quickly. So even though it's a ways away from this, it made a nice move, which means that, you know, we are in the summer months, so maybe people are positioning themselves on more staples. That's a nice trend right there. Healthcare. Healthcare might be one of the strongest looking of all. You can see that it had probably the steepest climb of all back in January. This is a really nice move. A little frothy. I'd let it come to you, but the healthcare sector is definitely something that I am researching to find what else is areas of opportunity in there, because this is a nice uptrend. Utilities, we already looked at the XLU. You have a straight up shot, breakout, kind of trying to hold that breakout, so we'll just wait and see. You got a golden cross, so it's now in a bull market, and if you want to look at it a little bit differently, you can draw this bottoming pattern, kind of a box around this bottoming pattern, and then it broke out, and now what was resistance is now support. You see that? The long-term moving average was resistance, resistance, support, support. XLF, it's in an uptrend, but it's lagging, and I think it's going to lag a little bit just because the last 1 or 2 days, I think, just kind of keeping our eye on the interest rates overall. So, you know, for the most part, everything is still bullish. I think that we're at a point where if you're looking to put some money to work, I just maybe look for an oversold in the S&P 500, you know, coming out of a oversold RSI 5 type of situation. Let the market come to you a little bit. If you want to look at some market breadth real quick, I can just show you that everything looks good on the bullish side. So let's look at this. So 72% of stocks are above the 200-day moving average in the S&P 500. So, you know, we're in a bull market. You expect bullish outcomes, but at the end of the day, it's clear to me that interest rates are at an inflection point. It could be a multi-month pullback, which could be a multi-month move for utilities and bonds. And I think that the market is just at a point where it could ease for a few weeks. But right now, everything's still looking pretty good. It's hard to argue this bull market right now. So I hope all is well. I hope you have a great weekend, and let me know if you have any questions.